Welcome to the Emerging Markets Finance panel of the 2021 Annual Conference of the Global Research Alliance for Sustainable Finance and Investment, short GRASFI. My name is Christoph Nedopil, and I am the Director of the Green Finance and Development Center at Fudan University, and had the pleasure to chair the executive committee for this conference. So I'm absolutely excited about today's panel. Many emerging markets for decades have been able to attract global investments from both private and public financial institutions. This has lifted billions of people out of poverty and has partly improved equity in many emerging economies. In the aftermath of COVID-19, however, future economic development in emerging economies looks challenging, with debt crises, a continued health crisis, lack of economic opportunities, risking social unrest, and of course, unresolved as well as accelerating environmental issues. Against this backdrop, this panel will discuss recent developments and challenges for sustainable finance and investments in emerging economies, including, of course, the question of China's increasing footprint in emerging markets finance. Today's panelists could not have more expertise and diversity to provide relevant food for thought on these challenges, and hopefully also some solutions. The panelists come from all aspects of emerging markets finance, development finance, private finance, academia, export credit, insurance, and economics, and work in almost all corners of the world relevant for development. Now, the panel is structured in two ways. First, we will discuss questions on the trends of emerging markets finance, responsibilities of different players, and challenges of international cooperation. And second, we will open the panel for questions from the audience. Now for this, please send us the questions via the chat function throughout this panel, all throughout the panel. I will also remind you again, but don't be shy. Altogether, we will have 60 minutes for this panel. Now, first of all, let me introduce the panel, and the panelists, you're more than welcome to turn on your camera. First, we have Sana Abu Zaid. She is the International Finance Corporation Country Manager for the Central American region. Based in Panama City, Sana leads IFC's operations in Panama, Costa Rica, Nicaragua, Honduras, El Salvador, and Guatemala. She has extensive private sector development experience as well, having worked across investments and advisory services operations for more than 17 years. Sana, great to have you here. Next,
thank you, Christoph. Pleasure to be here.
Next, we have Kevin Gallagher. He's a professor of global development policy at Boston University's Frederick S. Pardee School of Global Studies, where he directs the Global Development Policy Institute. Kevin serves on the United Nations Committee for Development Policy and co-chairs the G20 Task Force on International Financial Architecture. His specializations include economic development, trade and investment policy, international environmental policy, and Latin America. Kevin, so wonderful to have you here. Paul Milon, the head of stewardship Asia Pacific at BNP Paribas Asset Management, has more than 13 years of experience in the asset management industry. He's now leading stewardship activities of BNP Paribas Asset Management in Asia Pacific, and his work includes direct and collaborative corporate engagement, working with policymakers on key issues relating to sustainable finance and investment. So Paul, awesome to see you as well. Next, we have Ansette Severe. She's currently a senior economist at the financial sector, Deepening Kenya, FSD Kenya. As a development economist, she has over 10 years of experience working in Africa on economic research, analysis, and strategy development. The focus on macroeconomics, manufacturing, private sector development, the informal economy, finance systems, digitization, green finance, and trade and investments. So she really covers the whole waterfront. I'm very, very happy to have you here, Ansetse. Last but not least, I'm very pleased to welcome Ms. Zhao Zhang. Zhao Zhang joined Sinoshore's International Department as Deputy General Manager in 2015 and is now responsible for international networking, development outreach, promoting the practical cooperation with leading international credit insurers, and the in-depth research on international rules and best practices related to officially supported export credits. Very warm welcome to you, Zhao Zhang. I'm very, very pleased to have you all here in this panel. Now, I want to open the floor with a very, I think, not softball question, but I think a very obvious question. Now, what are, in your opinion, the development priorities in the post-COVID-19 world in the different regions and for the different players? Now, we just had kind of your introduction that you do cover a lot of different fields and expertise and responsibilities. And I would like to understand kind of what, in your opinion, particularly in the aftermath of COVID, are the priorities in the different regions that you're particularly serving, and of course, of the different players. And I would like to give the floor first to Sana from IFC to share your thoughts on this question.
Thank you, Christoph. Good morning, good evening, everyone. A pleasure to be with you all here in this distinguished panel. Look, Christoph, to me, the priorities really have always been there. Now, have they drastically changed? I do not personally think so, but I do think that the prioritization, the order, the urgency, and the magnitude of many of them have definitely been reshuffled over the last year and a half, or a little bit more than a year and a half, that we've been living through the COVID crisis, obviously. I would say that the four key components that still remain a priority and perhaps have been pushed a little bit more upfront would remain, obviously, financial inclusion. And I'm talking specifically from a Latin American perspective, but many of this would apply to other emerging regions around the world. But I would say that number one, we're looking at financial inclusion, and number two, we're looking at digitalization, three, climate, and four, the whole PPP agenda. And let me just maybe talk to each one very briefly. So for the financial inclusion front, and here we talk obviously about MSMEs, we talk about gender, women access to finance, and so on. And the data is there across the regions to tell us how important and how we should be prioritizing, obviously, this angle to kind of help with the economic recovery and kind of set a good foundation as we move, hopefully, beyond COVID at some point soon. SMEs worldwide, and more so in the Latin American region, play a huge role in the economies. We talk about SMEs being responsible for creating half of the jobs in the Latin American region, for instance. They need access to credit to thrive and create jobs, but most often they lack this access to credit, unfortunately. And we estimate, our research estimates that MSME finance gap in the region is about $1 trillion. That's a huge number. That's almost 19% of the aggregate GDP of the region. So there's definitely a lot for many of us to do in this space. And we also estimate that only about 55% of the adult population in the Latin American region have access to a bank account, which is huge for one of the regions that is actually one of the leading ones when we talk about emerging markets. We also estimate that 75% of small businesses systematically lack access to finance. A lot that can be done about this, but clearly one of the priorities. And if we are to focus on the women component of SMEs, the gap gets even larger. I mean, you take, for instance, Panama, where I am located. This has been the fastest growing economy in all of Latin America before COVID, and also it's known for its stable and really fast forward financial system. But even with that, when you look at the numbers, only 7% of adult women have access to a mortgage, and we all know how important that is for securing your future loans, and be it for your business, for the home, etc. So these numbers really are shocking when you look at them. And there's a lot that we can do, and that obviously IFC has done in the past. Happy to talk about some examples going forward. But clearly financial inclusion to me remains and will be front and center as we move hopefully forward from the COVID crisis. Digitalization, I won't spend too much time on this. It's on everybody's minds. We know it. I mean, most of us, I think, are still working from home, thanks to a camera and to a good connectivity system that allows us to continue doing so. But there's clearly a huge gap when you look at other people around the world. In LAC, for instance, only 13% of the population uses internet to pay bills. That's a huge opportunity in terms of investments and in terms of development as well. But here again, it's not the topic of the discussion today, but lots of questions on connectivity, on the quality and the cost of the broadband and any internet connection comes to mind. Climate clearly also absolutely front and center. And here we estimate that the market for climate smart investments in Latin America and the Caribbean will be over $2.6 trillion by 2030. Huge opportunity. There's a lot that can be done there. We all know this. Our resources are finite on this planet, and there's more that we need to be doing. And there's a real business opportunity for many investors out there as we kind of shape our agenda. The final component that I would focus on is the whole agenda of PPPs. And this has been the priority for a while, but honestly, after COVID, we know that governments around the world have stepped up, and rightly so. So they can basically help ease the burden on the private sector, on households and so on. But the negative side to this, obviously, is their fiscal spaces are getting even tighter. Resources are not that many now for many governments around the world. So these PPPs really bring that beauty of creating these large, sometimes infra and other sectors projects, while at the same time not being that much of a burden on the government and creating the jobs that everybody needs as we are recovering from COVID.
Thank you, Sana. That is a very structured and a very, very clear answer. And I think you're absolutely right. These are topics that are pre-COVID and post-COVID have not changed. The issues have not gone away in this regard. I would like to kind of then jump to Ansetse, kind of whether you kind of in the African space, on the African continent, also have this similar feeling that things have remained the same, or do you see that COVID and the post-COVID world has changed some of the development priorities?
Well, thank you, Christoph, and for inviting me on this distinguished panel. I think, first of all, Africa is not post-COVID. We're very much in the heart of it, with most of our population is not vaccinated. And I think that's been one of the defining features for a lot of Africans, is that the world seems to be moving on, but we're sort of sit here stuck with a very real reality that people cannot meaningfully engage in their economic activities because of COVID. So I think that's just the reality of vaccine inequality, and that needs to be addressed before we have any meaningful conversations on post-COVID. I think COVID has certainly had effect on the African economy at the macroeconomic level, at the sectoral level, and at the micro level in ways that exacerbated weaknesses that were already built into those economies, but also highlighted new problems that are going to be quite gnarly to get around. So I'll just try and briefly talk through those three. First of all, at the macroeconomic layer, I think the fiscal story is clear. But I think one of the things that I haven't been seeing a lot of that I think needs to happen more is that there needs to be an honest fiscal assessment of what Africa needs to get out of here. And I really mean this in two ways. First of all, I haven't seen any meaningful analysis of the fiscal costs versus the multiplier effects of a meaningful stimulus on the African continent. I think there's been a general assumption that Africa is too poor for any sort of like stimulus. Nobody wants to fund it, so it just shouldn't happen. So I think that's a conundrum that is meaningfully, impacting Africans today. I think the second thing is that there hasn't been an honest assessment of the cost of not doing anything. I think we've talked about poverty rising, etc. But if we continue letting things go the way they're going, ultimately the cost for governments, for development partners will be a lot more to get Africa out of this. So I think some honesty in the fiscal options that Africa has is the first thing. I think also the big thing at the fiscal level is the sustainability question. Obviously, a lot of the conversations on, Africa financing this recovery have been reduced to a conversation about debt. That has been a statement that's inaccurate for many countries. So I think adding some nuance there, but more importantly, looking at credibly lending to the continent. And I mean, that means long-term lending that's affordable. We're getting into a situation where there's almost a polarity in the financing options that a lot of African governments are getting. It's either you get it quick with no strings attached, or you get, long-term financing that has a bit more strings attached. So I think if you can have a bit more of a conversation around fostering fiscal sustainability in a way that centers the needs of African governments, I think that really has been lacking in a lot of some of the financing conversation. And I think, just to echo what Sana was saying, the resilience to climate change is a very, very big one. Because what we've been seeing is, because of the way COVID has decimated incomes macroeconomically, the ability of most Africans, whether it's the private sector or households, to extract the income they need to buffer themselves against climate change. And you've seen these impacts happening in Africa. There's been floods in Kenya or locusts or droughts or whatever. These really very pertinent issues. The real macroeconomic result is that because of bulk of African labor and the economy sit in those natural resource sectors, whether it's agriculture, fishery, tourism, whatever it is, because of that lack of income to buffer yourself, we're seeing this pronounced vulnerability to climate change and an inability, particularly the very poor that are stuck in smallholder agriculture, to get the resources to refinance their agricultural activities. So I just want to echo Sana that this is becoming a really big macroeconomic problem at a livelihood level. At the meso level, we've seen, and I've said this in blogs I've done for OECD, we have seen differentiated impacts of COVID at the sectoral level. We've seen some sectors that are the new winners, ICT being the biggest one, but you've seen some hibernating, trying to get on their feet. And then there's some that seem to be, frankly, going into some form of managed decline or a fundamental restructuring that will change the way they operate, the big one being tourism. So if you're looking at where your labor sits as an African government or whichever one you are, you have to start looking at where is your economy sitting in those sectors, where is your labor sitting in those sectors, and how do you start addressing it? Because in some cases, you do need to come in with remedial action, and we've seen that happening with some governments try to come in with funds to support businesses, but in some cases, you start have to looking at, is it time to let some of these go and allow the sectors that have been getting some attention, like manufacturing, that have been chronically, underperforming in Africa, to actually do. So I think continuing, to look at the sectoral differences and using that as an opportunity to restructure our economies is something that I've seen some players think about, but I think there's a real opportunity to go much deeper there. And I think on the point of digitization, I do want to echo what Sana was saying. I mean, we always get, particularly the country I'm from, Kenya, this sort of hype of all digital mobile money. But the reality is that digital inequality is beginning to deepen income inequality because of three main things. The hardware capabilities. If you look at the ability, the exposure that Africans have, not just to basic mobile phones, but to smartphones. Because now when you're talking about digital opportunity, in many cases, beyond sort of very basic services like, a mobile wallet, smartphones are really, or sort of feature phones are really just becoming critical. And because of that hardware inequality, we're seeing that divide happening. The second big thing we're seeing that's really impacting the ability of Africans to leverage digitization is their financial bandwidth. Because their incomes have been decimated, they really don't have money to do many of the things that they could have otherwise been able to do digitally. So if you're not going to deal with the income problem, then digitization just becomes another nice story that is told about Africa, when the reality is that most people are not able to meaningfully interact with that. And I think secondly, the third last thing is really the digital skills. Unless you start looking at the ways, particularly the African private sector, the micro, small, and medium enterprises are using digitization. And we've seen very interesting adaptations that some firms have been able to pivot to digitization, but they start hitting a wall in terms of their skills to really deepen that and to leverage the opportunities that provides. I think at the meso layer, those are really the things that we're really seeing that COVID has had an effect on. And finally, at the micro layer, we've really seen a divergence in income. So if you were sort of an African, but sort of fairly well educated, sitting in an office and you've been able to retain your job, retain your earnings, your income has been robust, but the bulk of Africans do extract the income from the informal economy, from the micro, small enterprise sector, and you've seen a complete deterioration in their ability to earn an income. We're seeing some recovery before these new variants of COVID hits and sort of countries started locking down again. But because of that, this massive divergence in income really means that you're seeing a thinning layer of fairly well-to-do Africans, and I do mean middle-income Africans. We're not talking about the elite. So we're seeing this attrition of this sort of middle class in Africa. And so what that means at the micro layer means that the abilities of households to feed, clothe, educate their children is really becoming a bit of a problem. And in some of the research that we've done, the biggest hit to education is actually income decimation, because even if you're going to a public school that's paid by government, there's still a cost linked to that. And because a lot of households really don't have any meaningful income as they used to, kids are really starting to be hit in terms of their ability to get to school. Let's not even talk about attrition in assets, selling assets. Let's also talk about accrual of debt, either in terms of goods or in kind. So I think really at the micro layer, we're seeing a real deepening of the vulnerabilities that's already there, and a real need for cash transfers to not only become an income support, but that really will become also a firm level support, as it will really build the abilities of people to actually buy things again in a meaningful manner. Thank you.
Thank you, Ansetse. I think that kind of your presentation here really shows the complexity and kind of the interlinkages between a lot of these different struggles and the realities on the ground. And what I'm very surprised about to not hear so far, and is kind of the role of the larger infrastructure, like transportation infrastructure, also for the future of development, energy infrastructure. And this is, of course, one of the areas that we are also tracking a lot kind of in the overseas financing world. Now, kind of, I want to put this question to Kevin. You are very much following particularly Chinese investment flows into the global South. And kind of, you're of course also looking very much at the effectiveness of different development policies. So from an academic perspective, what are we seeing? What should we be seeing more? What should we be focusing more in terms of development finance, in terms of effectiveness?
Thanks. Well, let me echo my colleagues in thanking you for inviting me to be on this panel, and it's great to be with this distinguished group of folks. I'd echo what Anetsa just said. You know, first and foremost, the most important thing is rapid vaccination across the world. That is the #1 impediment to any kind of development strategies. The second thing that's really changed is that we've lost time. Right before COVID started, we did a study with the Brookings Institution, which found that globally, and it varies across regions, that the world was short about 2.1% of GDP on an annual basis to meet its sustainable development and climate change goals. And 2/3 of LDCs LICs were already approaching debt distress. That was before. And so, as my colleagues have already mentioned, we're in a situation where we have to mobilize more amounts of money with tighter fiscal space. And one thing that hasn't been said yet, so I'll highlight this. One of the biggest concerns that I have over the next decade horizon is the growing divide in the cost of capital. The advanced economies just raised $17 trillion at 1%. Like Annette said, when an African country can go to some African countries can go to the markets really quick and unconditional, but sometimes upwards of 9%. And in this environment of tight fiscal space and a looming debt overhang, the math just doesn't add up. We're not going to be able to mobilize the kinds of finance that we need to meet all these goals. I'm from the North. I'm not going to say what Latin America, Africa, et cetera, should do in general, but specifically, but in general, we need a fundamental green structural transformation that's socially inclusive, from financial inclusion, reducing inequality, et cetera. And that takes different things in different countries. But we can't avoid the fact, especially in this panel, that that's a resource mobilization issue. And there has not been a commensurate increase in the base capital of development finance institutions to deal with the sustainable development goals, nor has there been one to respond to COVID. We're going to need a lot more public capital to try to address this cost of capital divide. And one of the key things that public development banks will be able to do is credit enhancement and using their preferred credit status and their good credit to be able to bend down those costs. On the China end, Anetsa mentioned multiplier effects. If you look, one of the things that from a counterfactual perspective, if it wasn't for China, things would be a lot worse. The overseas public investment that China has made in the wake of the financial crisis in 2008 on the public end has equaled the World Bank finance. And according to recent research published in the American Economic Journal by Axel Dreher and some of his colleagues, Chinese overseas investment has been strongly associated with economic growth and structural transformation, meeting a lot of these infrastructure bottlenecks. Whereas World Bank finance has not been. There's been no association with growth, even though it is cheaper. The China Development Bank and the Export-Import Bank of China have incredible deep pockets, but they also have the same business model as many of the MDBs. And just because of the credit rating of China and so forth, it's more expensive for a country like Ecuador. Many of their loans, especially to the China Development Bank, are 7 to 9%. Luckily, the China Export-Import Bank blends its financing with grant financing, and so their cost of capital is more traditionally somewhere between the 2 and 4% range. You know, certainly not the industrialized 1%, and not what you're going to get from the World Bank and some of these others, but still relatively cheaper. One of the big challenges is the development finance and development has become politicized because of the growing tensions between China and the United States, which as an American, I think is very unfortunate. And that if we can't work together, and I think we should be working together, I think there's some great examples in Latin America. China has set up a number of equity funds in the Inter-American Development Bank that bring in private sector actors and work with locals. Lots of triangular cooperation with national development banks, local private sector actors, and the Inter-American Development Bank and the Export-Import Bank of China. Unfortunately, the appetite for that has diminished. If we can't do that, because we have to have an all hands on deck to try to deal with this cost of capital and mobilize financing for all of these needs. If we can't literally work together and really coordinate across these institutions, we at least have to collaborate and be conscious of how this is working. And sorry to end on a bitter note, but we're in the middle of a crisis of multilateralism right now. And it's not only because of the US-China divide. The world is not coming together to deal with what I said is my first point and the most important thing to do in terms of dealing with vaccines. We need to mobilize finance for vaccines and addressing the virus. We need a TRIPS waiver at the World Trade Organization. We need technological transfer, and we need financing for that effort. That should be the global collective effort over the next 18 months. And if we really can't do that, a lot of this other stuff that we're trying to talk about, which are pressing things that basically the future of civilization really rests on, are going to fall by the wayside. This is the most serious public health and global economic challenge that we've seen in the 21st century, way more than the financial crisis of 2008. Thanks.
Kevin, at least you're not mincing your words. I think that's a strong message that needs to be received. I want to kind of pick up some of the things that you said about China and China's role in the developing countries and also supporting their growth. I couldn't be more happy than to ask Zhao Zhang about this. So for some people might not know Sinosure, I will give do my best to give a very brief introduction. Sinosure is the most important, I always say it's the most important financial institution supporting China's overseas investment, and particularly in the Belt and Road Initiative. It is the secret player because everybody focuses on China Exim Bank and China Development Bank and some of the private financial institutions, but Sinosure is behind a lot of the financing as an export credit agency and insurance company. So of course they play a very, very important role, and have also just kind of elevated the environmental and social risk management framework. And so I would like to understand kind of what is currently where we're seeing some slowdown, at least of official Chinese financing into some of the global South. What is the future of Chinese export credit agency like Sinosure, but also China's support for development over the next years? What is the strategy? What can we expect?
Thank you, Christoph, for the introduction. Good day, everyone. This is Zhao Zheng greeting from Beijing. My pleasure to add some ECA elements to this discussion. As Christoph has mentioned, Sinosure is China's Export Credit Insurance Corporation, the so-called Export Credit Agency, ECA. We are mandated by the Chinese government to support Chinese suppliers, contractors, and investors to develop the international market. We work together with more than 200 Chinese and international banks to make the deals happen. We have specific insurance products applying to short-term trade, medium long-term projects, and overseas investment, respectively. Actually, globally, there are more than 70 ECAs in different countries, doing more or less the same as Sinosure. Emerging market is Sinosure's core business area, especially in the medium long-term projects and overseas investment field. Energy, infrastructure, and the manufacturing industry are the main sectors we cover, which is also in line with other major ECAs. Since China has made the commitment to make all efforts to reach carbon peak in 2030 and net zero in 2060 last year, more and more emphasis is being put on the co-building of Green Belt and Road Initiative, including the development of green finance. Sinosure plays an important role in the BRI co-building and has done a lot of work to facilitate the unimpeded trade, financial integration, and the infrastructure connectivity. Sinosure is right now also on the path of a green transformation with new guidelines on green development issued and a special task force lead the green transformation established. In this process, we think that it is critically important that all the financial institutions upgrade internal policies and the risk management mechanism to guide and support their clients to decrease the carbon emission activities and increase the low carbon business. The most recent trend we notice is the green transformation policies of the ASEAN countries, the Association of Southeast Asian Nations, who are making great efforts to upgrade the existing energy structure, aiming for cleaner, greener, and more sustainable energy. For example, we see increasing demand for renewable energy from ASEAN countries, such as Vietnam, as the Vietnamese government is adopting encouraging policies shifting to clean energy. Also with RCEP, the Regional Comprehensive Economic Partnership signed and coming into force, we anticipate more project demand from RCEP countries, majority are the ASEAN countries. Actually, ASEAN bloc is now China's biggest trading partner. Right now, our colleagues of Sinosure are working intensively on the new demands and are seeking innovative tailor-made solutions to accommodate these new requirements, both efficiently and sustainably. Thank you.
Thank you so much, Zhao Zhang. I think that gives really a strong overview of kind of the breadth of the work and kind of course also the centrality of Sinosure in the Chinese overseas financing landscape. Now, I want to move to Paul. We have heard a couple of times, starting with Sana, about the role of PPP, of public-private partnerships. And of course, Zhao Zhang also just mentioned the role of co-financing. Then Kevin mentioned the capital mobilization, and Setse could not be kind of more strong about kind of this challenge for a lot of the countries to raise capital, particularly social capital. Now, Paul, you're sitting at one of the largest asset management companies. You're not necessarily doing project finance, but you do investments in a number of regions. And you're, of course, also very much involved in kind of this ESG field to integrate the environmental and social and governance aspects into financial decision-making at BNP. What is the role of the kind of private financial sector, and what can they contribute in this, I think, not easy time where indeed we are kind of not putting enough money into emerging markets, which kind of just exacerbates the risks rather than alleviates it. Like if there's no money, then of course it's going to be harder and harder to do development. And with that, we are increasing actually also the financial risks in these countries. So what is the role of the private sector, and how can that be pushed forward?
Thanks, Christoph. Yeah, definitely. I think when we talk about the COVID-19 crisis, it has definitely put a big kind of focus on social issues, but also on the emergency of addressing climate and broader environmental actions. So we've had a lot of talk about loss of biodiversity, but also our climate is becoming worse and worse and how time is kind of running out. And as a result, we saw an increasing number of investors, whether investors such as ourselves, asset managers, asset owners, having an increasing focus on sustainability issues. Three key themes that we put forward within BNP Paribas Asset Management, and which relate quite well to what the other panelists have mentioned, are the energy transition, the need for the energy transition, for more environmental sustainability, so which covers areas such as biodiversity, for instance, but also a more inclusive, so equality and inclusive growth. So we call them the 3 E's. And what is interesting is all these are very interrelated, right? Climate has a disproportionate impact on more vulnerable populations. Loss of biodiversity, deforestation has a greater impact on climate, etc. So with that, we see more and more investors having a focus on aligning their portfolios with objectives such as net zero, or on reducing their biodiversity impact, to give some examples. If we look at the Asian region, it's all the more important as Asia both has an increasing impact on climate and other sustainability issues. To give an example, China is around 27% of greenhouse gas emissions, which is still far lower than the US on a per capita basis, but it's a large part and an increasing part for the broader region because growth is also higher. But it's also more greatly impacted. If we talk about natural disasters, for instance, Asia is a region that gets particularly impacted. Taking just an example about people suffering from floods every year in South Asia, it could rise from just 13 million to 94 million without action on climate change. So with this, we see, as Zhao Zheng mentioned, an increasing kind of focus on governments, obviously looking at taking net zero objectives, but also with that, companies moving in that direction as well. Zhao Zheng mentioned increasing interest in renewable projects, in going through that kind of energy transition. And for us as investors, this means two things. One is across the portfolio of assets that we manage. And when we invest in private financial company, we invest in different companies, looking at how these companies are integrating climate and broader sustainability risks in the way they operate, because increasingly this has an increasing financial materiality in terms of how these companies are likely to perform in the future. So for us at BNP Paribas Asset Management, we have a systematic integration of these environmental, social, and governance criteria, the most relevant one for each company, into the way we invest. But the other side of the coin is more the opportunity basis. And this is where there is also an increasing thematic opportunity in investing in businesses or in projects which have a direct contribution in achieving these sustainability or climate objectives. So for example, if we look at the energy transition theme, it represents a 115 trillion opportunity in the next decade. So it's a massive investment that are required, that will require the private sector, that may require PPPs as well. And with this, we see companies that are increasingly successful, that facilitate the deployment of renewables, or that facilitate like increasing battery storage or electrification of transportation, etc. And we see instruments rising such as green and sustainability bonds. So two sides of the story for investors. One is about integrating material risk that can have an impact on investment in order to make better informed investment decisions and ultimately generate better return for the investors. Second one, the opportunity side, which is more investing more directly in businesses and projects that can make a contribution to addressing these sustainability challenges.
Thank you, Paul. I think that's also very promising. I think that there's a lot more consideration now on kind of shifting the assets also in the right direction. Now, kind of to push you a little bit on that, I think we heard from Ansetse particularly, and of course also from Kevin, that there is this huge financing gap, and that social finance, private financial institutions are a little bit hesitant to go in a lot of these markets. So what needs to be done also to motivate more financial institutions to do that? Because it seems we definitely don't have enough money. That's the financial gap, the mobilization gap is huge. And this is of course also a question to everyone, kind of what are some of the levers that we can pull? And I also want to invite the audience to provide questions over the next couple of minutes, as long as we have this distinguished panel to answer some of these really tough questions. But again, kind of we're seeing this divide, we're not seeing enough finance. It's just a mobilization question. And first, kind of really to the private financial sector, what can be done and what needs to be done?
Yeah, so I can start to answer, and then I will let other like fellow panelists like contribute their views. But definitely, what we see is that there are like massive sustainability challenges, developmental challenges, and we are not addressing them in a sufficiently, efficient way. And when we look at sustainability challenges, time is kind of running out, right? So there is some progress. We talked about it, but it's definitely not enough compared to the scale and the pace that we should be following. So here, what we need is really kind of to enable a kind of virtuous circle where each kind of player has its role to play. So we mentioned, governments in terms of definitely kind of setting the tone, setting the direction. Let's say China taking this net zero by 2060 objective, which then can go into regulators, looking at how companies should disclose, at how investors should invest, how they should take into account sustainability risk, climate risk, how these also should be well structured so that you limit the risk of greenwashing, which in a way is a way to slows down the effectiveness of action, but also creates less trust in the system. This is also about like companies taking more and more action. If we look at the science-based target initiative, for instance, which looks at setting some targets that are based on science to address climate change. The growth in membership has been, and of commitment has been quite incredible. In just 5 years, we are more than 1,000 companies representing 20% of global market cap, which have joined and committed to the.
Yeah. Sorry to interrupt, but this is a lot of kind of from the developed countries. Kind of, we have to mobilize money for the developing countries. A lot of the science-based target initiative and a lot of these initiatives are driven by Western financial institutions that care about Western money, and that their mobilization of money is not the big challenge, as Kevin just mentioned.
Yeah, no, and you're right. Like for some of these initiatives, that would be the case. But I mentioned, for instance, you can talk about sustainability, which could be perceived before, and sustainable investment as something that is more kind of a Western theme. But what we've seen is, for instance, with commitments such as that of China, that it's becoming something that is also owned by emerging markets. And with that, we see, when we saw China committing to net zero, we saw the oil and gas companies, we saw the financials companies also supporting that goal. Obviously, some countries have a greater kind of ability to mobilize capital than others. And on that front, in terms of how this can be done, I think that other panelists are better positioned than me to answer.
No, I think it's kind of, we're not going to find a solution here. I think that would be great. I want to similarly ask Sana about this. Kind of, what needs to be done, kind of, to mobilize more money, to mobilize more social capital as well. I think IFC has been, of course, been very strong in kind of also the investments in the financial institutions in order to prop them up, but also in terms of international cooperation, also with partners like China. That Kevin has mentioned before. Where kind of do you see the levers to mobilize more money to close some of these, or to address some of these challenges that you also mentioned very much at the beginning?
Look, in my opinion, I think the problem is obviously, the challenge is much bigger than any one of us alone, and we can only tackle this if we all put our heads together and our money in it together, and we really plan it adequately. And I do agree with my previous colleague here that it's a multifaceted issue. This is not just a development finance institutions or asset managers. Every one of us plays a role in this. The governments do as well. So everybody has their little own role to play that they need to push forward. And I do agree that in investments, putting money on addressing and pushing for some of these investments is important, but that's only, in my opinion, half of the equation. The other half is, how do you mobilize this money, and what do you do with it, and what kind of strings come attached with it, and what kind of practices do you push? So very happy to see some large amounts of investments flow in from governments and institutions. But then the question is, what kind of due diligence is done when this money is deployed? At what kind of advisory is given? What kind of technical assistance is given, so that we make sure that the investments are sustainable and they're really long term, and they're providing the value that we need. I can't speak for everybody, but I can speak for IFC. and how we look at it. So for us, climate is a major cross-cutting theme. I mentioned it in my my previous answer. This is a common theme that kind of is all over the investments that we do. We have clear and straightforward targets that we have until the year 2030 that we track on a constant basis. So on the one hand, in terms of the investments that we do, we push through the different types of industries where we are in. So for instance, in the financial sector, we're trying to push for specific climate-friendly investments, obviously, through the investments that we provide to financial institutions around emerging markets. The infra space is huge. A few of my colleagues mentioned this already. The investments in renewable energy, we've been in that space for a long time. We continue to push in. We exited the extractive, so we keep pushing in the renewables. Obviously, there's a lot to do, particularly in emerging markets. Transport is a major sector also that contributes a lot. So we try to green it and invest in projects that make sense. Municipal finance also, and this ties back to the tight fiscal space of subnational finance as well. You know, and then also in the real sector, in terms of agri, for instance, at what kind of practices and which kind of projects do you support? So I think the investment part is a big part, and it's important for us to play a key role there in terms of backing up the projects where we can make a difference and we can push, and hopefully, you know, other investors as well follow the same thing. When we do these investments, the second component for us is there's always a thorough due diligence that we do. We're known for our equator principles that many of the investors follow. And clearly the idea is we're not there just to throw money at the problem, but we're there also to provide the assistance to assess what are the environmental and social issues on a specific investment, and how do we, while we're investing, also help these companies improve their footprint and really improve their ENS practices. We do a lot of technical assistance and advisory services to clients and to non-clients as well to improve their ENS. We're pretty well known in that space. And then we work upstream a lot in this space, and we try to push from some solutions that probably are not going to bear fruit this year or next year, but we will see these happening in the future. And many of these we see, as some of you mentioned, in the first world, but and probably they are more suitable for middle to high income economies. You know, when you talk green finance, battery storage, all of these elements will happen first in these markets, obviously. And then, of course, once we prove that they're financially bankable, that they can hold the line, then you can push them in more markets, but they have to start somewhere. And that's, I think, the goal for these different investors. But again, the problem is much bigger than anybody. And I think all of us have to put our heads together, regulators, development institutions, investors, asset managers, the academia. I think everybody has their own bits and pieces to play. But the most important thing is, again, it's not just about the money, it's about how you use that money and how you really kind of be there with the company or the government that you're helping to kind of assist them, provide the knowledge, and really be there so that the investment is more sustainable.
Thank you, Sana. I think that's I think sums up also, again, some of the challenges, but also the priorities that we have to have. I have one question here, and I think I would like to ask it to Zhao Zhang. Is one of the challenges is, of course, the risks in many of these countries, which also, of course, makes investments harder. Now, Sinosure is one of not, I mean, export credit, but also I think much of the insurance sector is very good at evaluating risk and seeing maybe some of these risks very close up. Is that kind of how would you view that this risks and how do you also, as very experienced in managing these risks, how can we mobilize more private capital or more overall capital in such often risky environments and ensure that these risks are dealt with properly? Or where do you see also some of these risks?
Thank you, Christoph. I think it's quite a challenging question. You're absolutely right that Sinosure as export credit agency, we are a risk taker. We don't provide the finance directly. We just work together with banks and to facilitate. We absorb the risk, and the bank will provide the finance. So given the current situation, we do find the risk level is increasing. That's the reason that the whole company put much emphasis on risk management, because we as ECAs, we need to ensure our own self-sustainability that is regulated by the WTO. We think nowadays, with the new trend of the green transformation, for our risk assessment model, we need to integrate new elements like the environmental risk factor into, or ESG, those factors, climate change risks, into the model. For us, frankly speaking, it is a new project. So we need to cooperate with many other professionals and to find a objective way to assess these risks. It's quite challenging. We think this is the company need to invest more in the near future for this new trend. Thank you.
Thank you, Zhang. I think that's also very promising, kind of that Sinosure is looking even more so than before at the ESG risks and in their investment. Kind of, I want to stay with this risk question because I think that is of course kind of the financial sector. If it sees an opportunity, it goes there. But if the risk is too high, it will not go there. So kind of, Antje, I want to ask this question to you. Kind of, where do you see that some of these risks are also kind of almost self-perpetuating, and kind of how to break this vicious cycle? Because no money, as you said, no vaccination, things are going even worse, and then the risk is increasing. So how do you see that we can break this vicious cycle?
Thank you, Christoph. Well, I think first of all, the real risk is that Africa will just continue to be locked out of this conversation, and really because of three things. Even as we're seeing the sort of impetus to get into green and climate finance, what we're also seeing is that it's becoming an exclusionary force for a lot of African players, really three ways. The first way is that a lot of African players, it's a highly informalized economy. So when you're coming with green and climate finance, it's very structured, very formal. The breadth and depth of meaningful engagement for African private sector is really quite narrow. So it's really becoming an exclusionary, very elitist conversation. The second big way is that if you look at the divide of climate finance, it's very mitigation focused and not adaptation focused. If you look at the type of money Africa needs, we need the adaptation climate finance. When you look at a lot of the money, it's going to all of this carbon transition, all of this mitigation money. So, the work that we're doing in green finance, the real concern that we're having is that the lack of credible, creative, long-term financing for adaptation, which is a lot less lucrative, which is a lot less flashy, you can't make very big announcements about it. That's just sort of falling into the wayside. And we're having all these, Africa is being told to transition to net zero. I don't really understand what that means. When you're looking at a continent, in terms of pollution is not contributing very much. So the real big exclusionary force that we're seeing from an African perspective is just that divide in where green finance and climate finance is going. And I think the third big thing that we're seeing is African economies, I don't think, are being given sufficient support and financing to do their transition. If you're looking at the African economies that are fossil fuel dependent, and then you have announcements being made of, no more, we're not going to, finance coal, we're not going to finance oil and gas. What happens to these economies where a bulk of their revenue comes from these streams of money? So that is really the third big exclusionary force we're seeing, is that while people are trying to be enlightened, what's actually happening is that it's becoming a form of discrimination. And the reason it's becoming a form of discrimination is because there's no money being given to build the ecosystem that supports African economies to meaningfully have an engagement with all this green money that's floating around. So there really needs to be, in my view, in addition to the excitement around, very big players, which I think is very important during a green transition, what really needs to happen, whether it's in Africa, poorer countries in Asia, or Latin and South America, the real conversation is the system of financing to build the capabilities in those investment destinations. Otherwise, the conversation we're going to start having is, we made the money available, but there's no bankable projects. We already hear this already in the green finance. There are no bankable projects. But the reality is that your money is not speaking to the issues that those investment destinations are dealing with. So I think that's really, for me, the area where I get excited in terms of dealing with all this risk conversation is to deal with the African players, the South American players, the Asian players that understand the risks of financing in their context, that understand how to navigate informality, but most importantly, can translate the incredibly complex standards and requirements that come in the due diligence, that comes with the green standards to prevent the greenwashing and all of this. You need your own set of skills to understand what that means. Now, what does an African or South American or Asian private sector player doing with all that money? They can better go to their normal financial offers and just get their money there instead of dealing with the bulk of due diligence that comes with all this green money. So I think if you can start really looking at the capabilities in the ecosystem centered and manned by the players in those investment destinations, I think then a lot of these financiers will find it a lot easier to start deploying the sort of scale of capital. But that's notwithstanding the other issues I have around the way it's becoming a force of discrimination in many ways. Thank you.
And I think that's very, very powerful, and it kind of leads me directly to a question I want to ask Kevin, but I want all of you to prepare as well for the last question. We kind of very short kind of statement. We have 4 minutes left. What, in your opinion, is the biggest misconception on kind of development finance that you are seeing in your daily life, and that we academics should also be wary about in order to avoid some of the mistakes? But before everybody can answer this question, and Kevin, you can answer this question and the one that I want to ask you, following on Ceci's, it seems capacity, we are often talking about capacity building for emerging economies. Now, kind of what Ansetse just said is like, dang, you financial institutions, you need capacity building. You have no idea kind of about the realities on the ground. Green finance, we see it in a very different light. So who needs what type of capacity building do we need? If you can very briefly kind of answer this question, and then of course also the biggest misconception.
And one of the reasons why development finance institutions have been having such a troubled time over the past decade in mobilizing finance through all of this, the whole mobilizing finance agenda and blending and so forth, is it because the private sector has still been too reluctant, even though most of the development finance institutions have been socializing the risk and allowing most of the private sector to be able to get the reward, as problematic as that can be, and it's been really tricky in different countries on the ground. The fact of the matter is we're relying on development finance institutions to be regulators, and that's not what they are, right? They are supposed to be supplementers and first movers and things like that. And we've alluded to it with some of this greenwashing discussion and the sort of the misalignment of sort of the whole perception, is that we have to have a conversation about re-regulating the private sector for social goals. Since 1980, according to the FSB, the financial sector is over $300 trillion. It's increased by orders of magnitude, but gross fixed capital formation, the amount of just basic investment in the world economy, has gone down from 20% to GDP to less than 20%. And we need like 35, we need China type rates, not South Korea type rates of investment in gross fixed capital formation, 32% a year. And it's just completely out of whack and misaligned that an exchange traded fund or carry trade transactions are more bankable than distributed solar for social inclusion in Southern Africa, right? That's a fundamental problem with our financial system. And we have all these summits, and we ask development banks to do everything. And they work really hard, and all the numbers show it's not totally delivering. Some of the development banks aren't associated with growth, as I said. The Chinese.
Kevin, I'm sorry to kind of bring you to a close. What is there's much more to say, but unfortunately time is running out. What is your biggest misconception that you believe we're folly to?
Misconception meaning that things are going in one direction, but we should be going in another? Is that what you mean?
Maybe, or kind of the things that we don't understand, that we constantly get wrong.
I think we constantly get wrong the fact that we ask the private sector to do all this voluntary stuff, and it's not rational for them to do it the way that the playing field is set up. And so we need we need a reorientation of what the playing field looks like, so that the private and commercial sector is geared towards more social ends, and then things like development finance and civil society and public finance can be more aligned. And we never talk about the private sector need. Once there's a growing push against the backlash, greenwashing, we
Okay.
capitalize on that. Sorry.
Okay. Next, Sana, what is your thought on the biggest misconception that we are falling to?
I mean, this is going to go back to what we said a little bit earlier, which is that clearly this is a much bigger issue than any one player. And I think the biggest misconception that we have is that one of us has a magic wand that can come and, just change the whole picture. And in some cases it happens with specific projects, specific initiatives, when things are aligned and then you move forward. And there are many successful cases for several institutions, including the World Bank, for instance, and IFC and others. But what I would say that the biggest here concern that I have is that not everybody is playing their role adequately. The private sector, if you ask my opinion, I think is absolutely.
Sana, I will also have to interrupt you, and we're running out of time. And I also want to give the others an opportunity. Ansetse, what is, in 10 seconds, what is the biggest misconception? You already mentioned some, but what is the biggest misconception that really kind of annoys you when people repeat it?
I think that well-intended things have well-intended consequences. And I think we've seen this many times, but I think green and climate finance is just highlighting that even more.
Thank you. Zhao Zhang, what is, in your opinion, the biggest misconception that you're frustrated about that we are repeating?
Maybe my concern is that maybe some of the people have some prejudice about ECAs. I would like to take the chance to say that, as I've just mentioned, ECAs need to be commercially viable itself.
Okay.
That is what I want to say. Thank you.
Finally, to the private sector, Paul, what do you think is the biggest misconception?
Yeah, I don't know if it's misconception or maybe more a challenge. I think that one of the issue is like how to direct the capital, but then so how it's being used. So we need increasing, kind of standards to make sure that it's used in an efficient way. But that's where it's become as well a big challenge because I can only agree with Anzetse's point about the fact that bigger challenge mean also like bigger challenges. Bigger standards mean bigger challenges for smaller players, for more developing players, and therefore you may end up catering more for the developed part rather than the developing one.
Everybody, I really enjoyed this conversation. Thank you so much to all of you. Thank you for getting up. Thank you for being with us at GRASFI, and thank you also to the audience for staying with us. I really hope you enjoyed the discussion too, and I hope to see you all soon again. I think we learned a lot, and all the best for a wonderful day, and hopefully we get the vaccination going, because I think that has become obviously one of the largest challenges in terms of development finance. Thank you so much, everyone, and see you soon.
Thanks, Christoph. Thanks.